Welcome to the I Nurture videos.
Dear students, a business requires cash for its day-to-day operations. The cash flow statement conveys useful information about the firm's ability to generate cash. In this video, we will learn about cash flow statement, statutory norms regarding the statement, objectives of a cash flow statement, and also their inherent limitations. Cash flow statement measures the changes in cash balance between two accounting periods. Cash that comes into the business is termed as cash inflow, whereas that moves out of the business is termed as cash outflow. This movement of cash is revealed in cash flow statement. Accounting Standard 3 on cash flow statements details various aspects of a cash flow statement. Further, as per SEBI guidelines, annual reports of the companies should carry cash flow statements for the current year and the previous year. This facilitates the comparison between the two periods. We have to classify activities of an enterprise into three types for the preparation of cash flow statements, mainly operating activities, investment activities, and financing activities, and finally present their aggregate impact on the overall cash position of the entity. There are several objectives of cash flow statement. Let's look at some of these objectives. Number 1. Forecasting future cash flows. A cash flow statement for the past period can serve as a useful basis for preparing a project cash flow statement. This statement enables to identify cash surpluses or deficit periods of the future and plan for suitable courses of action. Number 2. Understanding liquidity position. Liquidity is an important requirement for smoother operations. Despite huge profitability, if liquidity is tight, firms can face difficult situations. Number 3. Identification of strengths and weaknesses. A cash flow statement, through the classification of cash flows under different activities, facilitates identification of a firm's strengths and weaknesses. Thus, the management can take appropriate remedial actions. Number 4. Evaluating efficiency in cash management. Careful scrutiny of cash flow statement helps us to develop pragmatic cash management policies with objective of higher profitability without compromising on liquidity. Careful analysis on any cash flow statement provides useful information. It provides useful information about the cash flows from different activities of a firm and also overall cash position of a firm. This helps the management in estimating cash needs for the future operations and maintain appropriate liquidity. Many a times, despite good profits, a firm may not have enough cash for payment of dividends or for other applications like purchase of fixed assets. Analysis of cash flow statement helps the analysts to understand the reasons for such scenario. Cash flow statements are one of the mandatory statements to be prepared along with other financial statements have inherent limitations. Number 1. The cash flow statement focuses only on effect of transactions on cash flow and it ignores non-cash items like bonus that may be significant. Number 2. Future projections of cash flows may involve significant new decisions that might not be appearing in the past statements. Therefore, at times, cash flow statements of the past will have a limited utility. Number 3. Organizations that are capital intensive or are seasonal will have unique cash flow pattern, which may not be reflected logically in a cash flow statement. Similarly, cash flow statements of an off-season period may not be comparable with those of a season period in case of a seasonal undertaking. And number 5. Cash flow statements may not be useful if used in isolation. The statements have to be studied along with the other P&L and balance sheet. To summarize, in this video, we have learned about cash flow statement, statutory provisions regarding preparation of a cash flow statement, objectives of a cash flow statement, and also their inherent limitations. Trust you will find this information very useful.